Good day, subscribers, and welcome to Momentum channel. We have an exciting video for you. We're going to take a look at two dividend stocks with monthly dividend payments and their dividend yield being over 6% at this time, which is just remarkable. And the fact of the matter is that both of these companies actually pay their dividend and are considered to be safe dividend payers. But what makes them quite unique is the fact that if you compare their dividend yield to that of the S&P 500 as a whole, you'd see here on this chart, the S&P 500 dividend yield, the latest was at 1.28% dividend yield. Definitely quite low, and with the inflation growing at this time, this dividend yield for S&P 500 as a whole is definitely not even capable of beating the inflation alone. In that sense, these two companies with their safe dividend can be quite interesting choices for many dividend investors. Without any further ado, why don't we get started and take a look at the first one. First company for us to review is a company called Main Street Capital. It is traded on New York Stock Exchange, the ticker symbol MAIN or MAIN, and it is in financial sectors and asset management and custody banks. Main Street Capital is a business development company, or BDC, and for those of you who might not be familiar, BDCs primarily provide debt and equity capital to relatively small, highly levered companies that aren't able to access traditional financing from banks. As a result of that, Main Street is able to grow its revenue and collect its actual revenue through that option of using the money to lend to companies that rely on that fundings. Main Street has separated itself from the pack and boasts a track record of never decreasing its regularly monthly dividend since making its first payout in 2007. Their ability to actually consistently do pay their dividend income since 2007 is a track record that Main Street Capital is relying on. On top of that, Main Street success has started with its diversified investment portfolio, which consists of more than 150 companies. From a company size perspective, they are considered to be a mid-cap company with $2.85 billion in market size. From a dividend perspective, as we promised you in the beginning of the video, both companies are paying a dividend yielding more than 6%. In this case, for Main Street Capital, their dividend yield currently is at 6.07%. And if you look at the volatility of the stock, it has a beta score of 0.82, which is considered to be average volatility. And when we compare that to that of the overall stock market, the beta of 1 suggests the same level of volatility as the overall stock market. In this case, this company is a little bit less volatile than the overall market. Moving on, if we look at the dividend track for the Main Street Capital, you notice here that they have a payout ratio of 109%. This is considered to be very high for BDCs. Obviously, what it stands for, the fact of the matter is that when the payout ratio for the company is more than 100%, they are using their entire funds to cover the dividend income that they're paying. That can be a little bit of a red flag for sure for us. Their forward payout ratio is a little bit better, although it's still considered to be high at 102%. Nonetheless, perhaps the silver lining here is the fact that this stock and the company has actually managed to consistently pay its dividend for 13 years without any reduction. So that's considered to be decent. They never reduced their dividend, but in the past 10 years as well, consecutively, each and every year they have considered to be actually increasing their dividend amounts. So 13 years of uninterrupted dividend payment, and 10 years of which the 10 past years has been increasing dividend year after year. And they are paying their dividend on a monthly basis. Their annual payout currently is at $2.52 per share. From a valuation perspective, Main's current dividend yield of 6.07% is about in line with its own 5-year average of 6.2%. That's shown here in the graph that I'm pointing out. This suggests that the stock may be reasonably valued today. Additionally, their forward price to earnings ratio of 16.7 is about in line with their own 5-year average of 16. The market appears as a result to be valuing the stock similarly to how it has in the past, suggesting that Main could be fairly priced if you believe in the health and long-term prospects of the company. That being said, if we compare the forward price to earnings ratio of Main Street to that of the financial sectors, you notice that for the financial sector, the price to earnings ratio is actually lower at 12.5. This usually happens if the investors are optimistic about the firm's strong growth profile and their superior business model or the durability of its earnings stream. These qualities need to be persistent to continue justifying the stock's premium multiple. From a stock price and comparing that to the stock price range over the past 1 year, you'd see that the last trading price of $41.50 is hovering a little bit closer to the price of $43.41, which was the 52-week high price for the stock. The lowest price that the stock has hit over the past 1 year was at $27.39. Looking at a number of other financial metrics, we are taking a look at the earnings per share, the number of outstanding shares, the total sales, as well as the stock price kind of trend over the past 1 year as well as 5 years. Let's start with EPS. From an earnings per share perspective, ideally we would like to see the net investment income per share here kind of consistently grows. It's not consistently year after year. For instance, you see here that in 2019 and 2020, the earnings per share was down compared to the year before, in particular compared to 2018, though it was still higher than 2017 when you compare 2019 to that year. Having said that, since 2020 and the last 12 months, if you compare that, it seems that the company is gradually recovering and its earnings per share is actually showing an upward trend. So the last 12 months is showing an earnings per share of $2.25, and the next 12 months is projected to be at $2.48. Again, moving back upwards. That's the nice trend that we would like to see. As for outstanding shares, the number of outstanding shares, ideally we'd like to see a company that maintains the number of outstanding shares or perhaps even declines that. That being said, it is also important to check that earnings per share is rising over time. In this case, although they are increasing their number of outstanding shares, the promising part is that their earnings per share is also growing. Because keep in mind that due to the high payout ratios for BDCs, it is generally common for them to have to borrow money and issue shares to grow their business. So while typically an increase in the number of outstanding shares for all the companies might not be something that you expect all the time, but for BDCs, it is a little bit more common, as we just talked about that. And you see for the last 12 months, they have a total number of 67.4 million outstanding shares. In terms of the total sales, it is very promising to see overall upward trends. As we mentioned, there are years that, like for example, in 2020, their total sales went down from a total revenue perspective, but the last 12 months they are showing to be $245 million in total sales, which is the highest over the span of the past 10 years. So that is definitely a positive sign for us to see. In the two graphs at the bottom of this page, we are looking at the stock price return over the past 1 year as well as over the past 5 years. Let's start with the past 5 years and the graph that I'm just pointing out to. In the past 5 years, you'd see that main stock has returned total return of 20.89%. This is not considering and taking into account the dividend amounts, and it's purely based on the stock price volatility. The positive close to 21% in 5 years. It's decent when you take into account as well a very decent dividend that the company is paying to. And on the other part, if you look at the past 1 year, it's just a remarkable return, a very good recovery for the company since its lows. And you see that they are showing a 37% return in the past 1 year. Quite remarkable. Again, this does not take into account your dividend amount that you're collecting on a monthly basis from this company. And as we pointed out, they've been paying their dividend uninterrupted for the past 13 years. All right, and now let us take a look at some of the analyst estimates and the pricing projections for the Main Street Capital Corporation. There are two analysts on TipRanks, with both of them having a buy ratings. The average 1 year price target for the stock is at $44.50, according to analysts here on TipRanks. If that holds true, as of the last trading price for the stock, that shows an upside of 7.23%. Now, let us take a look at the analysts on Yahoo Finance. Here, the 1 year targets established for the price established for the stock is at $43. Again, that shows some upside for the stock. If we move on further and take a look at the Simply Wall Street, here we're looking at the current price and comparing it to the fair valuation for the stock price at this time. According to Simply Wall Street, the stock is considered to be overvalued compared to its fair valuation by about 16.8%. Again, these are different data points that you could take into account. If this is a stock and a company that interests you, you are more than welcome definitely to do more research on this and perhaps wait for buying opportunity if the stock has some pullbacks and presents even a more lucrative opportunity for you to pull the trigger and possibly add it to one of your kind of holdings in your investment portfolio. All right, before we continue and look into the second stock with a monthly dividend paying with more than 6% annual dividend yield, I have a favor to ask you. Here you can see on Momentum Finance and Stock Investing channel, we post videos every week about investing in the stock market, as well as different ways to invest, including real estate and crypto, and ways to reach financial freedom. We really would like to have more like-minded fellow investors and individuals join our channel. With that in mind, we'll really appreciate if you can subscribe to our channel and watch out for our future videos. And of course, if you found this video beneficial, don't forget to give this video a thumbs up. Thank you. All right, with that, let us take a look at the second company that is paying a juicy dividend of 6.33% annual dividend yield. It is in the energy sector. It's considered to be an oil and gas storage and transportation company. The company is called Pembina Pipeline with ticker symbol PBA. It is a Canadian company, and of course, as I mentioned, it is traded on New York Stock Exchange, but also available as for Canadian investors in available on Toronto Stock Exchange. For the sake of this video, we are looking at the company's stock on New York Stock Exchange. So every pricing valuation is by USD, and all the calculations are based on the US performance of this stock. That being said, a lot of the numbers could be comparable in that sense because it's the same company that we're looking at. From a dividend safety perspective, the safety score for Pembina Pipeline is at 80, which is considered to be safe. And looking at the volatility of the stock, it is exactly at 1, which is considered to be average volatility. The company Pembina Pipeline is considered to be large cap with $17.3 billion in market capitalization. Pembina Pipeline, it was founded in Alberta's Pembina oil field in 1954, and it has become a major midstream service provider with a network of oil and gas pipelines, storage facilities, and processing plants located primarily in Western Canada. The firm's energy infrastructure serves as a one-stop shop for producers to move their hydrocarbons produced in Canada to the highest value market throughout the world. By commodity, Pembina's business is balanced across oil, gas, and natural gas liquids. And many income investors are drawn to the midstream industry because of the stable cash flows that it provides and their generous dividends that it's offered. Pembina's CEO, Michael Dilger, said it best. Our job is to build annuities, highly predictable cash flow streams that will last a long time and that will underpin our dividend. Looking at the key metrics from a dividend perspective, the company's payout ratio is currently at 62%, which is considered to be low for pipelines. That's a good sign. Their forward payout ratio is again 63%, considered to be low for pipelines, allowing them a lot of room to grow their dividend for the years to come. From the performance of the stock during the recession, if you look at it real quick, during their recession of 2007-2009, the company's sales were actually up by 6.9%, which was considered to be above average growth during those years. The company has been paying its dividend uninterrupted for the past 22 years, of which the past 9 years they have increased their dividend year after year consecutively. They do pay their dividend on a monthly basis, and their annual payout currently is at $1.99. From a valuation perspective, Pembina's Pipeline's current dividend yield of 6.33% is 24% above its 5-year average of 5.09%, which indicates that now could be a reasonable time to invest unless you believe that the company's outlook has weakened. Furthermore, PBA's forward price to discounted cash value forward ratio of 9.9 is close to its 5-year average of 10, And as a result of that, it appears that the market is valuing the stock similarly to how it has in the past, suggesting that PBA could be fairly priced if you believe in its long-term prospect remaining solid. And if you look at the 52-week price range, the last trading price of $31.44 USD is hovering a little bit closer to the 52-week high price. The 52-week low price for the stock was at $20.45. Looking at their discounted cash flow per share, which is calculated by subtracting interest expenses, taxes, and maintenance costs from EBITDA, and it is similar to free cash flow for pipelines, and the best pipelines usually tend to increase their earnings power over time to help fuel their distribution growth and stock price appreciation. So that's why it's an important measure for a pipeline company. Hence, we are looking at this chart. You'd see here, for the most part, they have been gradually increasing it, although it's not consistent year after year. There are some ups and downs, but for the most part, they've been increasing it. Since 2018, though, there seems to have kind of stalled and a little bit of down. In fact, for the last 12 months, their DCF per share was at $4.09, and for the next 12 months, it's anticipated to be at $3.96, which is kind of the lowest since 2018. In terms of shares outstanding, the company currently is showing 551 million shares outstanding. Pipelines retain little cash flow due to their costly growth projects and high payout ratios. And some pipelines depend on issuing shares to help finance their growth, which can create challenges if their stock price is in the dumps due to weak investor sentiment. In this case, it doesn't seem to be the case for Pembina. You see here, for example, the past 1 year, the stock has done phenomenally. In fact, the stock price has been up by over 44% in the past 1 year, which is just remarkable. And if you look at the stock price return over the past 5 years, it's showing an overall return of 3.22% over the past span of the 5 years. Their total sales is a little bit of that cyclicality. There are some ups, like 2014, they were at as high as $6.07 billion in sales. Then from there on, it went down and it recovered back up in 2018, reaching one of the highest over the span of 10 years, actually. In fact, the highest total sales they had in the past 10 years at $7.35 billion in sales. Nonetheless, in the last 12 months, they were showing again some signs of recovery with $7.26 billion in total sales. Lastly, let us take a look at some stock price projections by analysts. There are 7 analysts on TipRanks covering this stock for Pembina Pipeline, with 3 of them having a buy rating and 4 of them having a hold rating, resulting in a moderate buy. The projected average price by analysts for the stock is at $34.69, and if that holds true, that shows an upside of 10.34%. Analysts on Yahoo Finance are showing to have a price target 1 year of $33.48. And lastly, if you look at Simply Wall Street, from a valuation perspective, the stock is believed to be undervalued by about 18%, 18.2% to be exact, compared to the fair valuation of $38.43 according to analysts on Simply Wall Street. Well, there you have it, folks. A quick look at 2 stocks with a juicy dividend of 6% plus that do pay their dividends on a monthly basis, and both of them having a safe dividend at this time. I hope you found this video beneficial and gained something of value from it. Let me know in the comment section below if you are invested in any of these stocks. I would love to hear from you, so be sure to provide a comment down below. If you found this video beneficial, don't forget to give this video a thumbs up, and of course, don't forget to subscribe to us here on Momentum Finance. Here on Momentum, they post every week several videos about investing in the stock market and real estate and crypto, as well as ways to reach financial freedom. Thank you, and we hope to see you next time.